How can diversified assets underperform during a bull market? Imagine watching a race where only a few runners are sprinting ahead while others are moving at a steady pace. In a strong market, the same thing happens with investments. Some stocks or sectors shoot up quickly, while others stay flat or even decline. When you spread your money across many different types of assets, not all of them will rise at the same speed. During a bull market, the biggest winners are often concentrated in a few sectors like technology or healthcare. If your portfolio includes bonds, cash, or stocks from slower-growing industries, these may not keep pace with the high-flying sectors. This means your overall gains could lag behind the market's top performers. Diversification is meant to reduce risk and smooth out returns over time. But it also means you might miss out on the fastest gains during a market surge. For example, if stocks are soaring but bonds or real estate are not, your diversified portfolio will not grow as quickly as a portfolio focused only on stocks. This is because diversification limits exposure to the highest returning assets at any moment. So, even when the market is doing well, your mix of assets might not reflect the full upside. Another reason for underperformance is that some assets included for safety, like bonds or cash, tend to generate lower returns during a booming market. While these assets help protect your money during downturns, they can drag down your gains when stocks are climbing. For instance, bonds might produce small or negative returns if interest rates rise, which can slow your overall growth. From a financial planning view, this underperformance is a trade-off. Diversification aims to protect you from big losses and provide steady growth over time. It's not about making the most money in a short period but about managing risk and avoiding big swings. During extended bull markets driven by a few sectors, a diversified portfolio might seem to be lagging. But it's designed to keep your investments safer over the long run. Other factors also play a role. Investors might feel disappointed when they see headlines about stocks that double or triple in value while their diversified holdings grow more slowly. This can tempt some to abandon their strategy and chase quick gains. Market environments matter too. When a few sectors dominate the market for years, diversified portfolios naturally trail behind those winners. Behavioral tendencies can influence these outcomes. Short-term investors often want quick results and may lose patience when their diversified investments don't outperform. But sticking with a diversified approach helps avoid the risks of putting all your eggs in one basket. In practice, financial planners emphasize the importance of long-term discipline. They explain that temporary underperformance is normal and part of the process. Properly designed portfolios consider your goals, risk tolerance, and time frame. Clear communication helps clients stay committed, even when their investments seem to lag during a market rally. It's also important to remember that diversification isn't perfect. Some asset classes may not perform well in certain environments, so regular review and adjustments are necessary. This ongoing process ensures your portfolio remains aligned with your needs and market conditions. In summary, diversified assets can underperform during a bull market because they include investments that don't keep pace with the strongest sectors. This is a natural result of spreading risk across different assets. While it might seem frustrating in the short term, this approach aims to protect you from bigger losses and provide steadier growth over time. Staying committed to diversification is a key part of smart financial planning.